Friends, welcome back to another video. We've been trying to record another video for you guys for quite some time, and every time I get a script ready, every time I get a whole video ready and send it over to our compliance department, frankly, the news has changed, and it keeps changing so quickly lately, it's hard to keep up. But especially it's hard to send out accurate information to you guys. So here we are. It's Thursday evening, it's April 10th, and I'm just going to give you the update as it stands today. It's going to change probably tomorrow, but I want to begin to kind of fill in some of these questions that I'm getting, and maybe this will turn into a series of videos on just this topic. But everybody is wondering about tariffs. That is the topic du jour. So let's get into it. As you may have noticed, volatility has picked up. It's picked up quite a bit, and stocks have retreated from their recent record highs. Now, how did tariffs do this to the stock market? That is the question. How did tariffs do this to the stock market? It's super complex, but I want to try to break it down and again answer some of the questions you guys have been asking. You see, the stock market loves certainty. It dislikes unknowns, and we have a lot of unknowns right now. The stock market is a forward-looking pricing mechanism. The stock market is a leading indicator. It looks out into the future, 6 months, 9 months. It looks out there and it says, here's where we think this company's going. This is their earnings. This is their earnings projection. This is their profits. This is their revenue. And it's extremely hard to fill in those numbers when the tariff landscape keeps changing and evolving. And we don't know how much to add to each of these companies' numbers because the data keeps shifting. So April 2nd happened, Liberation Day, and the actual tariff amounts came out, and they were way higher than our analysts had expected. So you want to talk about uncertainty. We had begun to price in, here's where we think this is headed. Here's where we think these negotiations are headed. And we're off. Not just us, but everybody was off. Nobody knew exactly how this would play out. And this caused a lot of market angst. So 90-day pause. Yesterday, 90-day pause was announced. We're going to have a 90-day pause. Again, nobody knew this was about to happen, and markets had been selling off, and all of a sudden we have a 90-day pause. We have a 10% floor on tariffs for everyone except for China, and then the markets take off the other way. The markets rally, have one of their best days ever, and it's just been confusing because the markets are trying to look out in the future. It's a pricing mechanism, and they haven't known how to price things. So here's another example of the recent confusion and why it's been so hard for markets to find their footing. Well, initially it was thought that these tariffs were going to be of the reciprocal nature. So I was talking to a lot of you guys about this in meetings, and reciprocal was just going to be a very simple calculation. So you charge us 10% for X, we're going to charge you 10% for X. Hasn't been fair, now it's going to be fair. 10% for 10%. Some countries like Europe, if you have a VAT, if you have a value added tax of 20%, we're going to go ahead and add that on top. So we're going to charge you 30%. But it was just a very simple formula. Well, later on, they announced the tariffs, and it was totally different. It was totally different, and it caught everyone by surprise. So the actual equation they were using was this. The trade deficit with the respective country divided by the total amount of imports from that country. Then they divided that number by 2, and they said, here's your tariff for every country. And if there was nothing there, if it was nothing, they gave it a 10% minimum. So these numbers were way bigger when they were announced, way bigger than everybody thought. Total shock to the system. Market doesn't like shocks. Markets like certainty, and markets started going crazy. So as we move forward, this is why we expect things to smooth out, because during the 90-day negotiation, we're going to have some actual numbers put in place. We're going to have some certainty. Okay, Vietnam or Japan's in front of the line. Japan, you come in, go through this, go through that. Here's what we want to do. Everybody agrees, everybody signs, and this is the number. Then everybody that goes through that country can begin to make their estimates on their earnings and on their profits, and the market can begin to price in what they think the future will hold for that. So that's why we think it'll smooth out. It's been very rocky. Um, let's talk about the one country that is not in the good graces of our administration here. China. China. So you're hearing about China and you're hearing about a trade war. Well, what does that mean? What does that mean? I mean, a war sounds really scary. So what is a trade war? Well, let's first of all, a global trade war, any global trade war, generally, our economists, our guys, most firms believe that the U.S. would win. But first, what is a trade war? A trade war is when you escalate. We're going to charge you 10%. Oh, well, we're going to charge you 20%. 20%. Oh my gosh, we're going to charge you 50%. What in the world? 50%? I go 100%. See how it escalates. Boom, 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 higher and higher. That's the trade war. And it's kind of like this game of chicken. It kind of sounds silly when I actually say it out loud and I'm talking to myself here. I mean, it feels like we're on the schoolyard trying to prove something, but that's the trade war. But we really believe the US wins. And here's why. If you listen to Treasury Secretary Scott Bessent, he was an economics history teacher, and he explains it like this. The surplus nation is always in the weak position. The debtor nation always has the position of strength in these trade wars, historically. We are the debtor nation. We are the debtor nation. Hooray! I mean, who would have thought the debtor nation, there'd be something good about that, but we are. And it's frankly a record deficit right now. Well, that puts us in a position of power. He thinks that China's already in some sort of a recession. They have been slowing. They've had some real estate issues. They've had some different issues. And what they do is they manufacture a ton of stuff and they need us to buy it. They rely on us to buy it. So we import many more times um, items, goods than vice versa. Something like 5 times more. So we bring in a lot of stuff. They don't bring in as much from the U.S., not nearly as much. And so this is kind of logical. That this is the debtor nation piece. It's say it's 5 times more. That puts us in this debtor position. But it's kind of logical if you think about that stuff. If you're in China and you make a whole bunch of different items and the tariffs go up, and now it's 100% tariff, 200%. What if that price just doubled or tripled or something like that? If I'm sitting here in the US and I'm like, you know what? I'm not going to go ahead and buy that new pair of sneakers. I'm just not going to. I don't want to pay twice as much. I mean, I'll wait. These are, they're okay. We'll get by. Well, now they have all this stuff that no one will buy. Now they're not profitable. Now they have to lay off workers. This is bad news. This is bad news for China. This is really bad news. I mean, it's bad news for my feet if my shoes are compressed, but it's really bad news for China. So what does this mean for our forecast for the year? And I want to kind of tie it up like this. Coming into 2025, Raymond James had a forecast for GDP of about 2.4%. 2.4%, very similar to last year, in fact, 2024. And with each 1% increase in the effective tariff rate, and I'm not going to explain that right now, but the effective tariff rate, that could potentially reduce GDP by 0.1%, our analysis says. And potentially, because nobody's really done this. This is new territory we're in. But that reduction, there's going to be some reduction to our GDP potentially. and that could be this, we could see it made up in other areas, but let's talk about a worst case scenario. Well, that Raymond James has drawn us down to a revised forecast of 1%, positive 1%. Now, some firms are calling for a recession this year. Later this year, we're going to have a recession. Some firms have said we're in a recession literally right now. We're in a recession. I don't see that. I don't see that. But that would be something like negative 1% GDP or negative 2% GDP. So you can see it's eroded from, less than 3 down to 2, down to 1. If it goes into negative, now you begin to see that we're in a recession. So time will tell. I don't know for sure what's going to happen because we don't know the story with these tariffs and how much they're going to erode, revenues in these great companies. So I hope this was helpful. I wanted to at least take a little bit of time, fill in some of the gaps, answer some of the questions. I love getting your questions. Keep them coming. Depending on the feedback from this video, maybe this turns into a series and I just need to keep talking about tariffs and explaining what in the heck is going on out there. But I hope you enjoyed this. I really hope this helps. Thanks for all of your trust and confidence, allowing us to serve you. We love our clients. Thanks for all the referrals, and have a great night. Take care.